Good morning, everyone. It is Monday, June 16th. It has been Buckner and Dan Basse with Ag Resource Company. We'll kind of jump right into what will be a holiday shortened week. Juneteenth is Thursday, so we've got a 4-day trading week ahead of us. The big topic, of course, and has been since Friday, is the EPA's proposed volume mandates for blending of biofuels 2026 onward. We're all kind of struggling to digest what does this mean for actual production demand for something like soybean oil, and also the price of soybean oil and crush margins. And that's, I think, priority number one for the market this morning. Clearly, we're trading above previous limits in the soybean oil market. Grain futures down a little bit. I think fundamentally, Dan, this all makes perfect sense to us. I think we are trading kind of short-term fundamental input, and that's always nice to see. But if you wanted to go ahead and break down what you think about the reaction to the EPO's kind of surprisingly bullish numbers, we'll just jump right into it.
No, Ben, good morning, everyone. And it is good to get right into it because there's been a lot of volatility in the markets, not only related to the, of course, military action by Israel against Iran, but also, of course, changing policy within Washington regarding the RVO and those kind of things. Now, the RVO is calculated different this time. It's not based on D4 gallons. It is based on RINs. And so this is a different calculation. If you look at utilizing what USDA put out and what you're going to be getting from RINs from either a domestic, by that I'm saying US only, or an imported structure for feedstocks or renewable or biodiesel, you end up with different calculations. Now, if we just go back and use the breakout of about 1.56 RINs per gallon, you would end up with a D4 comparable mandate of around 4.6 billion gallons for the 2026 crop year. That's not that far away from the 3.95 that we were utilizing this year. But however, if you go back and then blend in the 50% reduction in terms of imported feedstocks or imported diesel, renewable diesel or biodiesel, you end up with a calculation of 1.27 RINs, and that gives you the 5.61 that USDA or EPA gave to us on Friday. And so, again, that's a mixture of 50% imported, 50% domestic. That number may or may not be right. This is a proposal that will now go to public comment. In July, we expect that somewhere between late September and October, we'll get a final announcement. And that final announcement could be different. Let's also explain to everybody that this does not include SREs, which are, of course, the small refinery waivers. And so there could be upwards of anywhere between 500 and 800 million gallons of waivers. And so that weighs heavily into this whole mandate discussion that we're currently looking at today. Finally, I'll tell everyone that we still do not have a federal subsidy for the production of biofuels. And so therein is also somewhat of an issue. But let's go through here and talk just a little bit about where we're at and what we think. If we look back at where the price of heating oil, crude oil, RIN values are, the production costs, everything associated with the production of biodiesel or renewable diesel, we come up with a target around 55 to 57 cents. Interestingly enough, there's also a 50% retracement on the charts, which comes in at roughly 56.14 cents. So an upside target for us at Ag Resource is that soybean oil should rally up to, let's call it 55 to 57 cents, 56 kind of as a medium. And that's where we see the market at least temporarily peaking until we know more about SREs, 45Z, and of course, what's going to happen with this EPA proposal on RVOs. So that's where we believe the bean oil market is heading. We're not that far away here this morning with July bean oil trading upwards of 54.11 at the intermediate close. So, there could be another 2 cents to the upside in bean oil. However, we look at soybean oil, we did make new contract lows. Soybean oil is pushing to the downside. So Part of this operation is that crush margins are going to stay very high. We believe that July soybean meal is heading to a $275 or $280 target, which would take the oil share back out to over 49%. So again, the meal market is bearish based on the oversupply of meal and what is going to happen in world markets, where the U.S. is going to aggressively compete with Argentina and Brazil for, of course, meal export availability. When you look at what that meal corn spread looks like, you can get a sense of this graphic here. Now, this is not broken down into poundage or maybe what it means to the ration in terms of contribution. This is a contract 1-to-1 Chicago corn versus Chicago meal. Now, if you look at it, we dropped sharply on Friday. We believe we're heading lower, maybe down to something like $250 negative on this spread. So if you think about it, meal's going to be very competitive in feed rations, and that's likely going to reduce feed and residual usage in the future quarters and years, looking upwards of 2027. So it is negative on corn by branding, just based on the lower consumption of corn because of the competitive advantage and the competitive availability of soybean meal. Lastly, one of the nomenclatures that has to happen in this is that we need to process more soybeans for soybean oil. It's a domestic stimulant program. We believe that the USDA's crush numbers could now be too low by upwards, as I said earlier, 50 million bushels. So if you look at this, crush margins are probably going to hold between $1.30 and $1.60. Highly profitable for U.S. soy processors. And so if you think about the overall future on this, the processors are going to do quite well. The functionality of crush is to produce more oil. And with that, you get a byproduct called soybean meal, which will be bearish. But I see no evidence, whether it's South America or the United States, that there will be a slowdown in crush operations from the soybean processing side of things. Lastly, since we've delineated where the oil meal market and where maybe soybeans are headed, we'll now talk a little bit about weather. U.S. weather looks absolutely fabulous. We've got enough rain across much of the Midwest. The QP forecast for the next 7 days is at left. You can see the abundance of rain in a state that needs it. Iowa, stretching northward into Minnesota, Wisconsin, Michigan. This is the bullseye in terms of if there's any dryness out there. At the same standpoint, we go drier across western Kansas, western Oklahoma, and Texas to get the HRW wheat harvest started. So good on all counts. And even in the South, where there's been so much rain across Arkansas, Mississippi, Tennessee, and Kentucky, there'll be some rain, but it's going to be more diminished. And so this will be helpful. When we look at temperatures, they're going to be above normal. So this is greenhouse growing conditions, and we see no problem with the weather forecast looking forward. Lastly, if you do want to find a weather problem, we would head to Europe. We do see that it's way too dry across much of Spain, France, heading into Italy, and then northward into Germany and Poland. This area is going to suffer from dryness for the next 2 weeks. And it is going to be very warm. We'll see temperatures well into the mid 80s or upper 90 or mid 90s, which for Europe is really quite warm. So this is going to produce some stress, particularly on the French corn crop. Now, again, I don't think this is going to immediately mean imports because their wheat crop is so large, but nonetheless, it's a supportive factor. And you can see in the temperature gradient to your right that this is a very split temperature pattern, depending on the Black Sea and Europe and where we're sitting today. So in a nutshell, Ben, we can move up to 57 cents in bean oil. We can move down to 275 in soybean meal. I don't think the soybean market has a lot of upside potential, let's say above 1080 relative to July soybeans. And the corn market and wheat markets are just bearish on the harvest. And again, the newfound competition for corn from soybean meal. Back to you, Ben.
Yeah, I think all that makes sense. And, the biodiesel market's been complicated for a long time, and maybe just gets even more complicated given the change in the calculation. But I think everything you said makes a lot of sense. And again, I think from a seasonal perspective, and we've highlighted this a lot, nothing has been very remarkable. I think that corn and wheat are down so far this week makes a lot of sense. And when you're talking about competition for feed demand, especially, I think that's something that we want clients to think about. So, there will be more soybean meal supplies competing with corn. you'll see in our research this week, we're going to start by class wheat balance sheets, and there's going to be a decent amount of hard red winter wheat across the plains, more so than the last several years. So it's going to be a lot of feed supply available to the marketplace, beyond the next month or so. And so again, it's competition to get rid of that stuff, not to ration it. So that's going to be, I think, a dominant theme through the rest of summer. France produces a lot of corn, but is it enough? You've got maybe improving weather in Ukraine, and of course, really no issues in the U.S. So again, summer weather market ahead. It's going to be a pretty exciting summer, we still think. Again, a dollar gets you into our stuff for 30 days. We're going to be doing a lot of work on soybean crush margins, what this all means. We get Renewable crush this morning. And then, of course, kind of defining the risk in grain markets for the next couple of months. So, as always, all the best in the markets today. And Dan, if you have any final comments, now is the time.
No, Ben, I think that pretty much catches it. We kind of ran overtime today, but it is a very important time to understand the renewable fuel story, and it's not over. There's a lot of parts and pieces yet to come. So twists and turns, stay tuned. We'll be ahead of this and try to give you some insight in terms of what it means. Have a great day and a wonderful week, everyone. Remember, we're off on Thursday for Juneteenth Day. Be well. We'll talk then.
Okay, bye-bye.